When the US Federal Reserve hikes interest rates, stock markets across the globe react instantly, including India. These decisions, made thousands of miles away, can trigger a chain reaction that affects everything from the value of the rupee to the performance of your favorite stocks. Investors, traders, and even everyday people feel the ripple effects, sometimes within minutes. But why does a decision made in Washington, D.C. send shockwaves through Dalal Street? Let's break it down. The US is the world's largest economy, and its monetary policy influences global capital flows. When rates go up, money often moves out of emerging markets like India and back to the US, impacting our markets and currency. If you're into finance, investing, or just want to know what affects your mutual funds and stocks, this video is for you. Whether you're a seasoned investor or just starting out, understanding these connections can help you make smarter decisions with your money. Today, we're decoding how the US Fed's interest rate decisions impact Indian markets. We'll explore why these changes matter, how they influence your investments, and what you can do to stay ahead. Hit like and subscribe if you find this helpful. Stay tuned as we unravel the global financial web and what it means for your portfolio. So what exactly is the Fed rate, and why does it matter so much? The Fed rate is the interest rate set by the US Federal Reserve, which determines how much banks charge each other for overnight loans. This rate acts as a benchmark for many other interest rates in the economy, from mortgages to car loans and even credit cards. When the Fed rate rises, borrowing money becomes more expensive for banks, and that cost is passed on to businesses and consumers. As loans and credit become pricier, people and companies tend to spend less, which helps slow down inflation and cool off an overheating economy. On the other hand, if the economy is sluggish or facing a downturn, the Fed can lower rates. This makes borrowing cheaper, encouraging people to take out loans, invest, and spend more, which can help boost economic growth and create jobs. The Fed's decisions are a delicate balancing act, aiming to keep inflation in check while supporting growth. But these choices don't just affect the US. They send ripples through global financial markets, impacting currencies, investments, and economies worldwide. That's why investors, businesses, and governments everywhere keep a close eye on the Fed's every move, knowing that even a small change in the rate can have far-reaching consequences. Why should India care about the US Fed? At first glance, it might seem like something happening thousands of miles away in Washington, D.C. wouldn't matter to us here in India. But in reality, decisions made by the US Federal Reserve ripple across the globe, reaching our markets and even our wallets. Because global finance is a giant web, connecting economies in ways we often don't see. Money flows across borders at the speed of light, linking India's fate to decisions made in the US and beyond. When the Fed raises rates, US investments become more attractive, so big investors often pull money out of India and move it to the US. This shift isn't just numbers on a screen, it can mean less capital for Indian businesses and startups, and more volatility in our markets. This FII outflow weakens the rupee against the dollar, making imports costlier and sometimes pushing up inflation at home. A weaker rupee impacts our economy and your investments, affecting everything from the price of fuel to the value of your savings. It's a tug of war that affects us all, reminding us how closely our financial future is tied to the world's biggest economy. When the Fed hikes rates, the dollar strengthens and the rupee weakens, making imports like crude oil more expensive for India. Higher fuel prices push up costs for everything from transport to groceries, leading to inflation. Your monthly budget feels the pinch, and savings lose value. That's why the RBI closely tracks the Fed's moves. Balancing growth and inflation gets tricky when global winds shift. Let's talk stock markets. When the Fed raises rates and the rupee weakens, sectors like IT and pharma benefit from stronger export earnings. But industries relying on imports or sensitive to interest rates, like autos and real estate, may struggle. Rising rates make loans costlier, slowing these sectors. Market sentiment turns cautious, leading to volatility. But remember, every dip can be an opportunity. So, what should investors do? Don't panic. Focus on your investment strategy and diversify your portfolio. Avoid overexposure to any single sector or currency. Keep a mix of domestic and international investments. If you believe in a company's long-term growth, global-driven dips can be a chance to buy quality stocks. Always do your research. To sum up, The US Fed doesn't control Indian markets, but its actions create a domino effect. Understanding this gives you an edge, whether you're a trader or investor. What do you think? Should India be this dependent on the US Fed? Drop your thoughts in the comments. Thanks for watching. Like, share, and subscribe for more crisp finance content.